was actually Purpose Investments' Craig Bassinger telling us he's expecting improved performance through the second half of this year after what was a very challenging start to the year. As I mentioned, that's just one view. The other view we were talking about there, Windcrest Capital's Barbara Ann Bernard, who for now thinks in many ways what we've been seeing is a bear market rally. Now, for Canadian investors, the mood of the markets is often measured through commodities, and stocks tied to those sectors hold a lot of sway on the TSX. Our next guest has had a long career on Wall Street tracking commodities, and he's fairly cautious in the case of the outlook for oil. Ed Morse is the global head of commodity strategy with Citi's research team, and he joins us now. Ed, thanks as always for joining us.
Pleasure to be with you today.
So obviously right now you've got in the stock market this debate brewing over whether or not the worries have been baked into the outlook, but there's so many unknowns when it comes to predicting a demand story in a weakening economy, and that's something you have to forecast in the commodity world as well. So from your vantage point, what's happening and where are we going?
Well, there's a sort of tug of war going on. Undoubtedly, the macro headwinds are very visible. We're seeing demand being challenged in the U.S. and Canada, actually everywhere around the world. We're seeing supply coming in a more robust way. So we think that we're seeing inventories building as they did build in the second quarter. On the other hand, there are some significant risks ahead. We're in the middle of summer. We've had more named storms in the Caribbean, the Atlantic Basin, than is normally the case for this time of the year. We've had no hurricanes, but the forecasts are for about 24 named storms, 6 hurricanes, 3 of which would be higher than what you'd call killer storms. And that's a real danger lying ahead on the supply side. And it's particularly the case that we have U.S. production that has been growing after it fell off. Prices are high, and we have to keep remembering it, first and foremost, because U.S. production collapsed by 2.8 million barrels a day as drilling collapsed in the U.S., and it's on the revival. And if it continues to be there in the market, we're convinced that other than some geopolitical risks that we can't really predict, we're going to have higher supply than demand through the rest of the year. But the dangers ahead, not only geopolitically, but weather-wise in particular, are really very strong.
Obviously, those are caveats we will watch very closely. But as I listen to you talk about the demand-supply realities outside of that, what does that tell you about where oil prices could be headed, let's say, heading into the end of the year?
Heading into the end of the year, we think they're going to continue to come off. We have penciled in a $99 Brent price on average for the third quarter. Given where prices currently are, just a few dollars above that, I don't see why that won't happen. We're seeing time spreads, the difference between the prompt price and the next month's price narrowing, which we see that happen while we have the noise of momentum going in one or the other direction every day. So all things equal, we think there's going to be continued weighing of oversupply in the market, especially as Russian supply continues to hold up on the oil side. So we're looking at prices being down to around $85 a barrel on average for the fourth quarter. Again, all else equal. We have a 50% probability of that, with risks to the up and the downside.
So that's in the case of Brent, maybe in that $85 level for the fourth quarter. WTI, I believe, based on your forecast, possibly a little bit weaker in the price term, getting a little closer to 80 overall as we take a look at that price at 96. And generally speaking, when it comes to the outlook for commodities, right now we're going to be talking a little bit later in the program about how capturing some of those commodities that had been locked essentially in Ukraine because of Russia's invasion might be finding their way to the market. Now there's some uncertainty with some of the fresh fighting we have seen in Ukraine. So that very much does seem like a wild card. For those who've been hearing all this talk about central banks, though, and cooling the economy on the demand side through higher interest rates, how much of that can ultimately be factored into the commodity story, which has, I think, for a lot of people felt like a separate story?
Well, it is not a separate story when it comes to other things, including interest rates. And if we see a slowdown in the economy, even faster than the one we're now seeing, that will impact commodities. Commodities are always impacted by the macro forces of GDP growth. We're seeing a slowdown in the largest economies in the world, in China, and the United States, and Europe, and Japan. And with that slowdown, usually you see commodity prices falling in order to get to the marginal price of supply, which would be available, or to shut in supply to make markets balance. So there's undoubtedly the case that interest rates going up, and particularly the Fed having interest rates going up, combined with the Chinese slowdown, is a very big headwind for commodities, and should be seeing weaker prices across the board, all else equals.
Ed.